That's it. I'm done. I quit trading. Well, at least swing trading. Well, at least for a little while. Now, for those of you that have followed me for a little bit, you know that I've been a big advocate for swing trading for many years, decades. I love the flexibility it offered, setting up trades, managing them over several days or weeks, and not being glued to my screen all day long. But markets evolve, and successful traders must adapt to those conditions. Hey traders, Robert Roy here from Wealth Builders HQ. Today I wanted to talk about a major shift in my trading approach that happened this year. Why I've largely switched from swing trading to day trading in 2025. 2025 has brought some significant changes and market dynamics. The U.S. stock market is experiencing much higher volatility due to aggressive tariff policies, economic uncertainty, and rapidly shifting investor sentiment. Major indexes have seen sharp swings, double-digit drops, followed by powerful rallies within days. Economic outlooks remain cautious with ongoing concerns about growth, inflation, and further policy shocks. Let's take a look at what's been happening with the S&P 500 and the VIX since the start of this year. So we're going to look at the S&P 500 and the VIX charts, and we're going to look to find extreme volatility in there. We're going to look for everything that's been going on, big drops, big rallies in this year, and let's see what's happened in coincidence to that. So I'm going to first back my chart up a little bit, and I want to get right from the very beginning of the year. So I can't do it exact, I'm close enough. Actually here. So this is January. So you can see in January, we had a little bit of a rise going into early January, and we flattened off until mid-February, and we stayed there. And then we had this massive drop in the S&P 500. That drop came after an all-time high. Now, when I say massive drop, it was a big drop, right? Traders were freaked out over it, very much concerned over the moves that were happening. Is this it? Is the world coming to an end? Markets go down, markets go back up again. It never just goes down and stays down. They always go back up again, right? We had a little bit of a pop in there, small retracement back up. We didn't even make it up to the 50 percentile of this Fibonacci, and then we failed. But look at the difference of this move here. Very systematic, very straightforward directional move. This one here, up 2 days, down for 3, gap down, rise for 3, big gap down, big gap down, big gap down. Oh wait, we gap down. We hit the 20% correction for the year, which means we're down 20% from the 52-week high. That is a correction. And that was our rally point from there. We bounce back up, we gap up the next day. Yes, it's looking good. And then we fail and go back down where we were lower than the previous day. We gap down and we have the biggest run we've seen in months, maybe in over a year of a one-day move on the S&P. We gap down and we're all over the place. We're putting in higher swing lows. We're now putting in higher swing highs, and we're starting along a pattern of a little bit more consistency. But is it going to last? Is it going to stay this way? I can't answer that question. You've got to trade what you see, and what I see has been yuck. It's been all over the place. Let's go take a look at the VIX. $VIX. Now I have my VIX broken up into 3 clear areas: red, green, and yellow. Now this is because of the type of trader that I am. I trade both directional, meaning buying calls and buying puts, and I trade with selling positions, covered calls, naked puts, credit spreads, iron condors, and the like. That means for me, the green zone is the ideal location. That is between 18 and 29. Anything lower than that is yellow, anything higher than that is red. Does that mean you don't trade there? No, it just gives me an idea of where my ideal is for my trading style. If I moved strictly to directional trades, man, I want the VIX in yellow. I want pure yellow. I never want to see another color. Why? Because the further down the VIX is, the lower the price of my options are. The least it's going to cost me in that trade. The smaller the big ass spread is going to be. The lower implied volatilities are going to be on the options as well. Well, from the beginning of the year, same thing, flat. We got this pop, we got that consistent move down, and then this move up to 60 was not unprecedented, but not something we're used to seeing. So if I back the market up a little bit, where do I have to go to find 60? I gotta go back to August of 24 before I could find something that got up. It was a little higher, but got up to that level. August of 2024. So 9 months ago. Very much sporadic moves all through here like the S&P, down, up, down, up, down, up. Remember, the VIX is an inverse relationship to the market. When VIX is coming down, the S&P is going up. They normally work in opposite to each other. Not always, but normally work opposite to each other. Remember when holding positions overnight was relatively predictable? Those days seem to be fading away. In this current environment, preserving your capital is even more crucial than ever. The increased market volatility that we've been experiencing has created different conditions for options trading strategies than in previous years. How so? Day trading provides flexibility in volatile markets like the ones we're seeing now. The high intraday price swings create frequent opportunities to profit from short-term moves, regardless of the overall market direction. Meanwhile, swing trading faces big challenges with market unpredictability. When you hold positions for days or weeks, you're exposed to overnight gaps and sudden news-driven reversals, which have become all too common in these turbulent markets. Instead of waiting days or weeks for the trade to play out, I can now identify multiple high-probability setups within a single day. This has significantly changed my approach to generating consistent returns in this market environment. One of the biggest reasons I've embraced day trading is risk management. I know, it's ironic, right? Day trading being more risk conscious, go figure. I know, it's ironic, right? Day trading being more risk conscious, go figure. By closing all positions at the end of each trading day, I completely eliminate the overnight risk. No more worrying about negative news hitting after the hours or geopolitical events affecting my positions while I sleep. Other reasons I transitioned to day trading are due to policy changes like tariffs and economic reports that can violently move markets, both during regular market hours and after market hours. This makes holding positions overnight difficult and exposes swing traders to significant gap risk. We've all seen those painful morning gaps that blow right past your stop losses. This approach has led to better sleep, more consistent results, and less emotional trading decisions. When you remove the overnight variables, you can focus purely on technical analysis and strategy execution. The biggest technical reason I moved to day trading is due to how option trades have behaved in volatile markets. Even when a trade moves in the direction we predicted, the volatility can actually suck all the profits out of the position if held too long. As an example, you could get into a trade. Let's say you buy an option when the stock is trading right here, and you buy a put option. You want the stock to go down, and you pay $10 for the option. That stock drops. Now the option is worth $11, $12, $13, whatever it is. The stock starts to climb back up again, and it gets back to where you bought it at 10, but now that option's only worth 6. Why? It's volatility. They sucked the premium out of the puts and they dumped it into the calls. That's why I've adapted our approach to focus on much shorter term trades. We're watching volume and momentum like hawks now. As soon as we see the momentum dying down, we're out of the trade. No questions, no ifs, no ands, no buts. There's no hoping for more. This disciplined approach has been crucial in preserving capital and capturing profits in this challenging market. Now I want to be clear, I haven't completely abandoned swing trading. I still take swing trades when exceptional setups present themselves, but for the most part, they haven't. But my primary focus has shifted to day trading using a specific approach. First off, I focus primarily on high liquidity stocks. I focus on the same batch of 20 stocks no matter what the market conditions. Number two is I look for clear support and resistance levels from the daily time frame, and I take my trades from the 5-minute time frame using a 1 minute to kind of tweak my entry. Number three, I implement strict risk management with predefined stop losses. Number four, I use options for many of my day trades to leverage smaller price moves. 5, I pay close attention to volume and momentum indicators. And number 6, I'm much quicker to take profits in this environment. This approach allows me to capitalize on the choppy, non-trendy markets we're experiencing. The current markets lack clear trends due to the back and forth nature of the recent policy announcements and economic data, which has led to sharp reversals and volatility crushes rather than sustained trends. Since day trading focuses on intraday price action, I can adapt and capitalize on momentum in either direction. Swing trading, on the other hand, is most effective when the market is trending, allowing traders to ride the multi-day moves. So before you rush to change your entire trading approach, consider if it's even the best trading method for you. Remember that day trading isn't for everyone. It requires more dedicated time during market hours, quick decision-making abilities, strict discipline and emotional control, a solid understanding of technical analysis, a well-defined trading plan, and the ability to adapt quickly to changing market conditions, such as a strong focus on risk management and comfort with higher trading frequencies. If you've been struggling with swing trading in the current market environment, or if you're looking to reduce your overnight exposure, day trading might be worth exploring. The decision to shift from swing trading to day trading wasn't made lightly, but it also wasn't my choice. It was what worked better in this marketplace. The key is to stay flexible and be willing to evolve your trading approach as the market evolves. The market won't adapt for you, so you must adapt to the market. I believe in volatile markets like we're experiencing now, day trading offers better risk control and more consistent profit opportunities if done reasonably. That said, I'm always ready to shift back to more swing trading if and when the market conditions change again. Whatever trading style you stick with, remember that success comes from consistency, discipline, and continuous learning. The markets will always change, and the best traders are the ones that can adapt. Until next time, make it a profitable day. Stay focused on the quest to becoming a great trader. Keep crushing it, and remember, you're just one trade away. Go ahead and click here for another one of our great trainings to help you become a better trader.